Hello traders, welcome to another video. And in this video, I want to talk about trading effectively. So this will not be about chasing profits and trying to catch as many trades as you can. This is gonna be about mastering trading and mastering yourself in the process being. So without wasting time, my name is Rocky Calvin, and welcome to today's lecture. I want to talk about mindset, which is the foundation in effective trading. So apparently the marking series from a previous video I did about the continuation of the how to read price action. That is episode 10 if I'm not wrong. I think you guys have already checked it out about XAUSD gold of what's really happening and what to expect in the coming week. I know XAUSD has been a little bit choppy and I don't know where we're gonna be pushing towards next week, but I would like to see some sales. I'd like to see some downfall. But that being said, I can't really say anything yet. We'll have to wait and see if we displace above here or below. So I have a video about that. But for this one, we're going to be talking about trading effectively. So trading is about 80% psychology and just 20% skill. You can be a very good analyst, a very great analyst, like you know where the market is going, where what price is up to, what price is doing. But if your psychology is not in the right place, then you're still going to lose money because it's more about psychology than skill. Often traders um, jump from one strategy to the other. I used to be like that back then. I used to trade ICT, I trade indicators, I trade from silver bullet strategy, I trade, the Asian range session, I trade Judah swing, I traded. I've done it all. I've traded, using the RSI, the MACDs, and all those indicators. I've done it all, and I used to jump from one strategy to another, even the double tops, double bottom, and so on. But that was not the problem because I remember during my early stages in trading, in just a few months, I was able to make good returns. And I was just trading double tops, double tops, double bottom, and head shoulder patterns. But the moment I started losing, I now felt like I need to upgrade my skill. So I started learning more. I went to indicators. After indicators, I went more into ICT. After ICT, I still feel like, there's something missing. Yes, it is true. There's always something missing because even with ICT strategies, it doesn't talk about everything. There's a couple of things that ICT usually don't say in public because they are too powerful and they're too precise that he cannot really. And even if you know them, doesn't guarantee you're gonna be winning because nothing works 100%. I think even ICT himself says that this game you can never win every day because these markets themselves, they're not even perfect. So at some point you're gonna fail. You're gonna go through some losses. So it's about your psychological maturity that's gonna make you consistently profitable. So detach from the money, then focus on executing good trades, not big wins. A lot of people are always about, if I take this trade, I'm gonna pass that perform challenge. If I take this trade, I'm gonna make a lot of money. But you see, the mindset is on about the result of making money, and that is not what trading is about. It should be about taking good trades, and when you take good trades, automatically that money follows. Good trades are not going to appear every day. It's going to take some days. You're going to be like the all week not even taking a single trade, because if it doesn't match your criteria or whatever you're looking for, meaning that it is not an A plus setup, then you don't have any business taking it. Then apart from that, you need to accept losses. This was something that I've really, 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 really struggled with, accepting losses. I'm a guy who used to love revenge. Anytime the market would do me bad, I'd be like, I know better. I know too much. I've learned so much, so I'm gonna get back at you. And you see, I was fighting something that is not even perfect. So I'm trying to put my perfection towards an area that's not even perfect. It could never work. So you need to accept losses. Losses are just tuition fees in the school of markets, meaning that just accept them, like it's going to happen. What matters is that profitability. If you're losing 1%, but you're making 2% per trade, then you're already winning it. You don't even have to win every day. If you're losing 1% and you're making or winning 3% per trade, that's 1 to 3 R. 1 to 4 hour, 1 to 5 hour. Then you don't even have to worry about the losses. But I understand the human psychology about losses. Sometimes it's so hard to accept losses because we have some ego and pride within us that usually takes hold of us not to accept losses for the way they are. So apart from that, also focus on staying patient. Great setups usually take time, and impulsive trades are the expensive lessons. If you start taking trades based because you saw somebody on Instagram or somebody on TikTok or X posting they bought a new Lamborghini or bought a new car, and you feel like you can do or you can achieve whatever they wanted to achieve, so you go to the markets and try to take trades because you have that ego that you also want to do whatever they achieve, which is okay, it's fine. But you see, you are doing it in the wrong manner because you are, first of all, you're not even sure that that person traded to make that money and buy and bought that car. They don't tell you the struggles that they go around behind the scenes. The secondly, this person, you don't know their account size. Maybe they're trading with millions of dollars in their accounts, and you're trading with just a profile of maybe a 10,000 USD or 25 or 50 or even 100k USD. You can never be in the same shoes with this person. So yes, they can inspire and motivate, but don't take it personal that you start taking impulsive trades which end up in expensive lessons. So discipline is about doing what needs to be done, even when you don't feel like it. That's what discipline is all about. You don't feel like, you know, giving up on that trade. You still want to hold more, but discipline is saying that once you get your 1 to 4 hour, once you get your target, walk away. Discipline says that if there's no setup, walk away. Discipline tells you that if situation is not looking okay, walk away. But we always want to fight back, and you see that is not discipline, and often ends up in losses and blowing accounts. So apart from that, I've once talked about, I think I did a video about risk management, and risk management is a very powerful tool. So, your capital is your lifeblood. Protect it ruthlessly. You're supposed to be risking at least, or let me say at most 2% per trade. Because if you risk more than 2% per trade, for example, if you're trading prop firms, you're just 5 losses away from blowing that account. And 5 losses is easy to gain, is easy to get them. The market can be just randomly giving you losses after losses after losses. Like, for example, the way these markets have been behaving recently, especially on gold, it's been like more of a consolidative market rather than expansion, or just like the normal aggressive market move. Okay, so risk management is a very, very important tool, and some traders usually feel like if they use stop losses, that's the reason why they're be losing money. I used to think as well as that, like, when you use a stop loss, these banks and these financial institutions, these big boys and so on, they're able to to see where liquidity, where stop loss is lying. Guys, the only way they can see where your stop loss is lying because they understand the concept of market structure and liquidity, so they know that there's liquidity below here. So a lot of traders will buy and put you their stop loss here. But these guys understand liquidity points. So they understand there's liquidity lying here and there's another liquidity lying above here. So once we take the above ones, we target the lower ones. So they come and take you out. Then after taking liquidity here, then you see market now starting. It's all about understanding liquidity. And that being said, some people prefer not to use stop losses. Now, stop losses is like a seat belt. It's not a suggestion. Just imagine a situation whereby you're overspeeding and you don't have a seat belt. Just think about what would have happened in case something happens. So stop losses is like your protection. You're protecting yourself against that aggressive move against yourself. Okay. Now you also need to understand the position sizing. This is a very important tool because you see, for example, position sizing is a situation whereby let me assume, for example, let me now move into 15 minutes time frame or maybe 1 hour. Yes, let me just give a very good example. If I was planning on buying, let me give you a very good strategy from this swing low to that high. I would wait for the market to come. This is one of my secrets, by the way, and if you've watched this video until this long, then you can have this for free. These are the measurements: 1, 0.75, 0.62, 0.5, and these are Fibonacci. Actually, I got this from ICT. This is not actually, but I use it in some manner. So from this swing low to this swing high, you wait for the market to come between the range of 0.62 to 0.79. You see the way it respected 0.79. Then let's assume it went, we were expecting this. Actually, you don't even have to wait, because once you understand what's really going on here, and let's assume you are now buying from this zone, from this 0.79, and your stop loss is just below this swing low here, and you're targeting, for example, maybe one or two of these specific Fibonacci level. So that's one. Let's assume you're targeting one, and that's around 1 to 8 R, which as you can see was, I think, was it met? Yes, it was met on Friday, and this is actually just Friday, all of it. So I want us to take a look at what was really happening here. So in case you bought gold from this level, this of $3,972.08, and um you are supposed to be taking profit up there. So position sizing in this scenario will be once this market moves aggressively from your entry point. For example, it tapped in and moved aggressively, giving us this swing low. So now you can swing, like you can position, like you can remove your stop loss from this low here to then this swing low here. So it becomes a break-even trade. You see that? It becomes break-even. And as it continue creating more PD arrays and so on, is how you continue to uh, uh, switch your position, like be able to protect your positions and so on. So apart from that, strategy is the age. When I began by saying that strategy, like psychology, plays 80% more than strategy and so on, but it is true. But without an age, trading is gambling, because you don't even know what you're doing. You're just out there, gambling, like buying and selling, and hoping that you win. That's gambling, and that's not how it works here. If you have that mentality, you're gonna lose money. You're gonna end up in depression, and a lot of things are gonna be happening. And you just have to have a strategy. You're gonna focus on one model, for example, using fair value gaps, order blocks, or liquidity sweeps, and then you have to master it. Then after mastering it, you have to back test. Don't just assume. You have to prove that your age works statistically. So build a checklist whereby you're gonna check the market condition. For example, the bias. Are you planning on buying or selling based on the bias? The entry trigger, what caused you to enter? Then risk and exit plan. For example, exit plan can be take profit or exit if something happens that you would not like to happen based on this strategy. So you need to have a checklist. And now execution is also part of this, because we'll always have this FOMO, fear of missing out trades, and FOMO usually happens when you don't follow your plan. So just follow your plan, journal every trade, both wins and mistakes, and just have that data, because that data is what's going to tell you where the problem is. When you read your own mind, you see, like, I made a mistake here best because my mind was you are nervous, maybe you are afraid, or maybe you just have issues. Your mental state was not really in the trading state. So you have to keep journals and trade like a machine. Then you're gonna be reviewing as a human. Just trade like a machine. So apart from that, the goal isn't just to trade more, it's to trade better. And when you align mindset, risk, and discipline, and consistency becomes inevitable. So with this being said, and even before I forget, also another thing that traders you have to be careful with, or you have to be aware of, is these markets usually evolve. So you need to stay curious. The reason why your strategy sometimes take losses consecutively in a whole week is because this market keep on evolving. And sometimes I feel like, you know, they often read our habits. That's why I tell you, there's no way you can tell me that you have a strategy that works 100%. No way. Because the way these markets evolve, so it is your duty or responsibility as a trader, for effective trading, you need to stay curious. So staying curious as the markets evolve, so you as a trader should be able to be evolving. So you're able to see things that you're supposed to be, paying attention to. And that being said, This is a lecture about effective trading. I hope this was helpful, and I'll see you guys in the next one. Cheers.